The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, everybody. This is Ken Cavula with the Mid-Michigan chapter, and this is the September version of the Manifest Investing Mid-Michigan Roundtable. We will start the program promptly at 8:30 Eastern Time, so you have about 10 minutes right now to chat with us, to test your sound equipment if you're so inclined, or to just drop us a note through the text, and that's in the questions box where you can text something, and I'll try to keep an eye on it during the evening, and if it's a question, we'll try to get it answered, and if it's something germane to the discussion, I'll try to bring it into what we're talking about. It's kind of a dreary bit of weather here today. It was gorgeous yesterday, and we've been moving into a glorious fall so far, so this is the first kind of rainy fall day we've had, but other than that, things are going okay. Beautiful sleeping weather. Mark, you're taking off for Illinois pretty soon, right?
Yeah, we should have pretty decent weather for driving and running around. And listening to the Cardinals on the radio.
And size down in sun country, so you probably haven't even heard of fall down there yet, have you, Si? Maybe Si muted himself.
He probably snuck away.
Ah.
Well, we're actually both quite hopeful that our Cardinals and Braves will get together in the postseason because his Braves are already there.
Well, I have a hand in the air from our friend up in Traverse City, one of the Mid-Michigan directors, Herb Lemkool. So, Herb, you're unmuted. Go ahead.
Yeah, Ken, just to let you know, I did talk to Provac today, and we're going to try and set something up maybe the first or second week of June on Saturday.
That's this coming June, right?
Next year.
Next year, okay. That sounds real good. That sounds real good. Once you get a date, I'll put it on the calendar, and we'll see what we have going then. Okay.
That'll be great. Do you have a preference that you and Ken might have, or you and Mark?
At this far in advance, I think both. I think June is pretty wide open right now. I'm pulling my calendar out right now for June 19. And I'm correct. It's wide open at the moment. So.
That's just after the convention, right?
Yeah, the convention gets us back on the 19th of May. So even if it's the first weekend in June, that's 2 weeks after convention. So that's not real bad, Herb, okay?
Well, that's perfect. I'll let you know and keep you posted on it. So
we have a large club in Petoskey also, Herb, that I visited a couple different times in the last 4 or 5 years. And we'll try to get word up to that club in Petoskey that we're going to try to do something down in Traverse City as well.
That'd be great.
Okay. All right, and then we'll if the sooner we can get the date set, the easier it'll be for us to get it into publicity for all the stuff Natalie sends out and everything.
I got a phone call into the Elks Club, but she hasn't called me back yet, so I'm sure I'll figure it out tomorrow.
Terrific. Okay, I'm going to put you back on mute here. Thanks a lot. Marty says, no need to mention the Reds. His team is out of it completely, Mark and Si. Okay.
I didn't want to bring it up because unlike Si, I have compassion for people.
We have two questions about two specific stocks. I don't follow either one of them, so I don't know. But Don would like to know our thoughts on Steel Dynamics, STLD, and Marty Eckerly would like to know our thoughts on MKTX. I'm not sure the name of that company.
I think that's
Market Access, maybe?
Market Access, yeah.
Okay, MKTX. So maybe if you could think about that a little bit during the evening, and we'll maybe react to that in Q&A after the meeting's over, okay? The two are STLD, Steel Dynamics, and MKTX, Market Access, okay?
Yeah, I do think we're seeing a little bit of inflection to the positive side on Steel Dynamics on the operating characteristics. So could be worth a look.
Okay. I'm getting a strange signal here. Oh, Cy says he's come back now. That the last time I made him an organizer, it made him pop off.
Yes,
Cy, can
sir.
you hear us? Boy,
Yes,
I've
I
never
hear
had that happen before. Let's try this again, Cy,
you.
okay? I'm
All
going to
right.
press that button again. And Cy, can you hear me?
Yeah, it worked that time.
Okay, it worked that time. Okay, good.
Yeah, it flashed up some stuff about recording and so forth flashed up, and then we were locked up and went away.
Okay.
Weird.
Guys in the audience, you got to give us a little bit more heads up about wanting to talk about a specific stock than just a couple minutes before the program starts. Susan would like us to react and provide an analysis of NTRS. Is that Nutrisystem? Anybody know for certain?
No, NTRS is Northern Trust, I think.
Northern Trust. Okay. So again, Susan and Marty and Don, if any of us actually follow these stocks, we'll of course let you know our thoughts on them. But I don't happen to follow any of those three. And you're right, NTRS is Northern Trust. I used to own that one. I don't know, 8 or 9 years ago in a club. John says that his portfolio has caught fire since 2017. Has something fundamentally changed in the market?
I have an opinion on that. I think 2017, I mean, you had some domestic political issues, principally the tax cut issues that happened. But the biggest thing that happened in 2017 is for the first time, certainly since 2008, Great Recession, you had all economies, Euro economy, the Far East economy, and the U.S. economy out of recession and booming.
Working in tandem with each other.
Correct.
Right? Now that might be starting to fray a little bit as far as the world economy is concerned. But
yes, it is.
But I agree with you, and I also think that the tax cuts have had something to do with some of this move in the market. I'm not sure that for the long term they're going to keep things as smoothly running as they are right now, but in the short term, I certainly think they had a little bit to do with what went on. Karen would like us to comment on Air Lease. So guys, we'll put these on our list, but Air Lease is a stock that I follow, but I don't follow it real closely, but it does belong in a couple of the club's portfolios that I actually own. Len Douglas from Southeast Michigan is chiming in. He thinks that the tax cuts also have had some influence on what's made the market move the way it's been moving. So we're getting some opinions on that from our audience. We do have about 1 minute left. If there's if you're not going to ask us to analyze a specific stock, usually this is just kind of informal chatting with our audience. So we're glad to have so many of you here this evening, and we hope that we will give you something to think about when we're all said and done at the end of the evening. I'll be joined tonight. Mark and I will be joined by Cy. Hugh's not going to be with us, but Cy Lynch will be here.
Yeah, the one thing that comes to mind with Air Lease before we get started is somebody posted about some fairly robust backlog news. They've apparently been building a nice pile of future business, and it looked very favorable for them.
Yeah, the stock watchers for Air Lease and the two clubs that I belong to that own that stock are very positive on Air Lease. They take pretty deep dives now. I will say that our stock watcher for Air Lease and the one club used to be Matt Spielman until Matt was moved to Ireland with his job. So I'm not getting quite the coverage of Air Lease that I used to get at a club meeting, but still, the gentleman that took over is very knowledgeable and says that things have been moving along quite nicely for that particular company. Doesn't see the last report was he didn't see any real problems, at least on the near horizon. Go on, Mark.
Plus, I think Matt will be chiming in from Ireland after he gets his feet on the ground over there.
I would guess absolutely he will be.
He's already done a little bit.
Yeah. Well, we've gotten a couple of emails that he misses the monthly meetings and he misses the interaction. Boy, we certainly opened up a Pandora's box. Chemneta would like us to comment on Healthcare Services Group.
Cool.
That's one that I do own that I am sort of familiar with, so we can talk about a few of these after the session this evening, folks. But again, if you want us to react to specific stocks, you have to give us a little bit more than the 7 minutes before a meeting to come up with some thoughts.
Because it doesn't give us time to expand. We can cover it in the Q&A afterwards a little bit.
Right.
We can knock out all those. Take a look at a couple things. All right, Ken, I'm showing 8:30. Are you showing 8:30?
I certainly. I'm going to sneeze right in my microphone.
All right. Well,
I muted and was back. Okay, so Mark, I'm going to be quiet and let you start the recording.
I'll let you have your sneezing fit. Let's go ahead. The recording's already started because GoToWebinar starts it for us. Something we're going to have to look at, but we'll go ahead and get started. All right. Welcome, everybody, to the few closing days of the baseball season and the September 2018 edition of the Roundtable. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and I'm joined here tonight by Ken Kavula and Cy Lynch. Ken is from Michigan. Cy is from Atlanta. He is a Braves fan, and both of them are renowned educators within the better investing community. And we just have a real nice time sharing some ideas with the audience, and we'll certainly be doing some of that tonight. Hugh McManus, once again, due to his day job, is unable to join us, so we'll press on without the Irishman along. We're going to spend a little bit of time reinforcing our annual quest for small companies, hence the needle in the haystack. Ken is going to cover parts as parts. They're in the middle of the picture, and then Cy and I are both going to cover a little bit of science with our stock selection tonight. Just real quickly, we'll get the legal paperwork out of the way. Again, this is all about education. It's all about showing people the analysis methods of the modern investment club movement, how we decide what is a better company and what is a better price. And that's what we're after at all times. So this is a demonstration, an illustration of those methods that are now pushing up on almost 8 decades, believe it or not, of use. No investment recommendation whatsoever is intended. If you want to, you or a friend or somebody that you would like to have access to these presentations, you can send an email to nkavula1@comcast.net, as it shows on the screen there. That's Natalie Kavula, and she takes care of the mailing list for the event. She will not inundate you with reminders, but we'll give you a couple of reminders every month. As far as the program, if you're bashful or you'd like a copy of any of the slides, or you have follow-up questions afterwards, my email address is markr@manifestinvesting.com.
Mark, I'm going to jump in for just a second. Natalie would like me to ask those of you in the audience that register through her email, she'd like me to ask if you've been having any issues signing in. We've gotten anecdotal evidence that there's been some issues signing in to get the registration taken care of. If you have been having any issues, could you drop Natalie an email and let her know exactly what's been happening so that we can speak to Citrix, that's the people that own GoToMeeting, and try to get the problem solved. It seems that some of you, when you press the link, have been taken to a YouTube video of a past session of Manifest, and right now we're having a very difficult time figuring out why that is happening. So if you are having some kind of an issue, if you drop Natalie an email, just a couple sentences about what you clicked and what happened, that would help us an awful lot.
Okay, we'll press on. We do record the sessions and make them available at YouTube. You can search Roundtable and Manifest Investing while on YouTube.com, and you'll find multiple years of presentations. This is our standing agenda. Again, a welcome, everybody, especially those of you who may be new. We keep this fairly informal. We do watch for questions from the audience in form of audio. If you have a microphone and sound equipment, and or questions can be submitted into, is it the question box or text box or chat box?
It's the question box, Mark.
Question box. So you can use that to text along if you have observations or questions along the way. We'll continue to look at our strong performance. We'll kick around. Those challenges are actually outdated. We took care of selling a couple of those companies last month, and we have a whole lot less house cleaning here this month. Do want to talk a bit about sectors and industries and some of the changes that have been made. And again, that reminder about the best small company stuff that we're doing. Our stock presentations are only 2 companies tonight. Ken is going to cover LCII Industries, and Cy and I both selected independently Simulations Plus, ticker SLP. We do pull
Mark, I'm going to unmute Cheryl, and she's had her hand up for a while, and
Okay.
let's see what her question is, okay? Cheryl, go ahead. You're unmuted.
Hi. I had heard on the radio this morning, and I didn't know if anybody else heard, Abbott came up with a cardiac clip that is supposed to be event changing in the world of doing heart repairs. And just wanted to let you guys know.
Oh, cool. Thank you. I'll take a quick look tomorrow morning when I'm looking for updates. Thanks, Cheryl.
Abbott's one of the 2 stocks, Mark, that I've owned since 1987 when we inherited a group of stocks from Nat's dad. So it's a long time holding, and I'd be happy to see it have another reawakening as a good, solid growth company.
Yes, that would be fine. I own it too. I don't think I've owned it quite that long, but it's a long time holding too.
Yeah, we've had it since 1994, so we're in unanimous agreement on that one over the long term. All right, this demonstration itself, this monthly webcast, is free. Again, have some fun, but we come together to basically share ideas and to illustrate the methods and stuff that we go through when we look at companies and evaluate them. We do keep track of a tracking portfolio. We'll look at that here in a minute. We do like to outperform the general stock market, here represented by the Wilshire 5000, by 5 percentage points. And that's quite an ambitious goal. And then we'd like to see the majority of our selections, greater than 50%, actually outperform a mirroring or a tracking investment in the Wilshire 5000. So we'll take a look at that. Here are the results. Again, we don't want to spend a whole lot of time here, but other than to just celebrate that trend is still going in the right directions. I like the way it's bending and seems to be heading back north above the +5 line. That red dotted line represents beating the market by 5 points, 5 percentage points over the period of a little more than 8 years. And again, that is a fairly ambitious goal. It's and we'd like to stay up above that and hopefully continue to head north on that chart. The actual rate of return, again, we're talking about 8.25 years now, is 18.7%. That's an annualized rate of return. So that's actually beating the market, which checks in just a little above 13 by a little over 5%. And about half of our selections have actually outperformed the market from the time of selection. So again, we do a cyber high five and just keep hoping that that'll continue to hover and hopefully even improve. Any questions or comments? Ken is on.
I think we're ready to move through here, Mark. Okay.
Okay. Sounds like you got the sneezing out of the way and good stuff. All right.
I did.
All right. Here's the actual portfolio. These are the 20 largest influences in the tracking portfolio. You can actually look at, I believe there's about 90 companies in the active tracking portfolio. You can reach that public link up at the top of the page. and these are the 20 largest positions, starting with our largest position in Cognizant Technology, going down to number 20 with S&P Global. You can see the actual dollar amounts. Again, the way to decode this page and the actual public web page itself is to use the legend up at the top. Every time we select a company here at the round table, whether it's one of the knights, a guest damsel, or the audience, we invest $1,000 into it. So in the case of Cognizant Technology, it's actually been selected 15 times, I believe 14 times by Mr. Lynch, because he's quite a faithful selector of Cognizant. So 15 times means that $15,000.
Patient consistency.
15,000 invested in Cognizant is now worth 27,000. So you can see, working your way down the page, we have multiple selections. Amazon is actually kind of an interesting story. That's a 2-time selection that is now worth 13,000. So some of these are just amazing. They've only been selected a couple of times and have made this largest list. So good stuff. The condition of the overall portfolio, Ken, do you want to spend a minute just kind of talking about where we at in terms of portfolio management?
Well, remember, folks, this is a tracking portfolio, and it contains many, many, many more stocks than a typical Better Investing Club portfolio would contain. We're keeping track of our ideas, and when we sell something, we're not taking that money and reinvesting it somewhere, because we're just tracking the ideas as they come through the program here. We do keep a dashboard, however, and Mark, I think the report card's on the next slide, right?
Well, the report card is that report card. No, we don't.
Okay,
we actually don't have.
We're not looking. We're not looking at the report card tonight. Well, we're doing the same general thing that we'd like to do in this other portfolio. However, we'd like to keep the par value in the sweet spot, and that's 5 points above the market. When I was working earlier today, the market average was a little bit more than 7%. So we'd love for the par value of the whole portfolio to be a little bit more than 12% right now. And we'd like to keep our financial strength on a weighted basis up around 80%, our earnings stability on a weighted basis up around 80%. And we'd like to keep our growth, again, on a weighted basis. That's sales growth. When you see a growth column on Manifest, it's always a sales growth column. We'd like to keep it somewhere around maybe 11.5%. So I'm looking at the averages at the very bottom of the page. PAR's a little bit below where we'd like to see it. Sales growth is also a little bit below where we'd like to see it. But we're in pretty good shape for a portfolio that's as old as this one and that contains as many different things. We've been trying in the last year and a half to be more consistent on cleaning house on a regular basis. So I think we're going to move to house cleaning here in just a moment. So I'm not at all upset with where the portfolio is. If I have to, however, if we add companies, I'd like to add a company whose sales growth is higher than 11, and I'd like to add a company whose par value is higher than 11, because that's how you take those averages that are a little bit below where you want them to be and push them up a little bit.
Just a comment on that, Ken. I quickly did the math as I was listening to you. This is a little over 50% of the portfolio by weight, not by number. And notice how few greens there are in it.
Yeah,
that's largely why that 10.3 is as low as it is.
Yeah, I agree with you, Cy. It's just very difficult in today's market to find good, solid buys. And then when you find them, this portfolio has a tendency, we don't tend to go back and stick with them the way we have with Cognizant in most cases. We tend to kind of shotgun these things. The one that draws my attention on this list, Mark, is CVS Health. It's been in the buy zone, I don't know, the last 4 or 5 years, I think. And it's looking like it's out of the sweet spot for the first time in a long time.
Yeah, because the price went up.
I had been questioning, when it was ever going to move out of the sweet spot. And it's still not above 80, but it has moved up enough to push itself out of that sweet spot. So
Yeah, it's gone up.
that's a little bit of glimmer of hope for that particular company.
See, those of us that have a little more faith and compassion for CVS are enjoying that 15 to 20% gain that we've seen here in the last few months.
Mark, the only question was CVS a rule of 5 stock? That's all.
Okay, the other thing I want to point out.
It was an honest question, Mark. Okay?
I know it. But the other thing I want to point out is that overall par for the portfolio, the overall return forecast for the entire portfolio is down as low as it is because our stocks have gone up so much.
That's exactly
cause for celebration.
That's right. This is the flip side. This is the flip side of that first chart you showed.
Right.
Yeah. And I think it's fair to say, Mark, that almost every stock that we bought when we bought it had a par value in the sweet spot or better.
Oh, definitely. With almost without exception.
Right. So when we see an Illumina right now with a par of 4.7, I can remember, debating on whether or not we should buy it when it was less than 100.
Yeah,
so
Illumina is a 4-time selection, so it's more than doubled in a fairly short amount of time. So again, so that actually leads us right into the selling discipline discussion. We actually have a kind of a 3-part selling process that we're trying to enforce here, and part of it is that handing off of the baton, finding a company that has had a strong run. When a company does have an inordinately strong run, its return forecast can actually go quite low. That leaves it vulnerable to a correction. And if the portfolio needs it, sometimes it's a case for act. So we'll look at that first. That's the traditional, can we make the portfolio better by selling one company and handing off to another? We don't have any rule of 5s tonight. There's only one that's even close to it. And then we do have a couple. We'll highlight one of them where the quality has slid a little bit, and we've got to watch that a little bit. So again, this notion of take the portfolio, sort it by the lowest return forecast, and these are the 5 lowest return forecasts in the tracking portfolio. And our community favorite, NEOG, again, a 2-time selection that is worth nearly $5,000 now, selected by Ken and the audience back in March 2016. It's behaved spectacularly well. And the result of that is that the par has been driven down. I think the real fly in the ointment here, well, there's 2 things I wanted to observe about this page, this section of the portfolio. They're all very high quality. These are excellent companies, so there's certainly no need to run for the exits. But the one that Neogen, that PE of 49 is the projected long-term PE. That's pretty ambitious. And the only saving grace, I mean, it's been extremely good to us, but the only thing that keeps us in this is the strong growth rate at 12-13%. And I know there's a bunch of shareholders in the audience of this one, so we don't need to sell anything. But if we were looking for a company with eligible for a timeout, we could possibly go with Neogen. But I think one of the things we ought to probably do is maybe do that case study we've talked about now for a couple of years of comparing Paychex as it matured, and it went from 40, 50, and 60 PEs, eventually headed back down into the 30s and 20s. Maybe we can come to some understanding as to what might lie ahead for Neogen. Again, excellent, well-managed company, but that PE probably cannot stay at 49 forever.
Well, it probably isn't, Mark. Joan is telling us that Neogen went down $14 a share today.
Oh my, well.
So maybe that case study is a couple days too late,
No kidding, $14. Okay.
But when you're sitting on a PE of 49 or 50 or 51, I don't care how good the company is, there are going to be times when, because it's priced to be just perfect, if you disappoint just a little bit, the market is cruel, and it's also very quick to move. So, Joan, I'm sure we'll get behind whatever is the problem with Neogen.
Well,
I happen to own it in one of my portfolios, so I'll be looking at that sometime in the next few days to find out what's going on. Do you know if that's due to an earnings report, Joan, or do you know the reason behind that? If you do, you can type it in the question box there, and we'll put it together.
I will tell you.
Kay is also pointing out, Mark, that the Illumina has another really high PE, but also a faster growth rate to go with it. Although
Right.
I wouldn't sneeze at a 12.7% growth rate either.
Right. Well, again, I've seen this many times in my career as an investor. Sometimes it can be something no more complicated than management being honest and talking about, well, growth is going to slow down, PEs are going to go down, and the next thing you know, the stock, again, any stock, it's not necessarily just the PE, but if the return forecast is 0 or approaching 0, it's vulnerable to a correction like we apparently have seen in Neogen. And
Well,
go ahead.
guys, let me just say something on Neogen. I know nothing about what happened today except I just Googled Neogen. The two top stories in Google: Neogen Q1 earnings beat estimates. That's Yahoo Finance.
Uh-huh.
The next is Neogen Q1 miss, pressure shares down 15%. Looks like there's two different perspectives on the report.
Well, it sounds like it.
Well, and I've been investing long enough to understand also that analysts can be very narrow in their interpretation of what's being said on an earnings call, and they can focus on one small thing sometimes, presenting a really great buying opportunity for those of us that have a little bit broader outlook and a little bit longer time span on what the company is going to be doing.
Yeah, I think Neogen is an example of one of George Nicholson's companies where he says, be careful about selling and walking away from a company that has a elevated growth rate. And I paraphrased there a little bit, but there's absolutely nothing wrong with this picture of Neogen. And yeah, it's going to have speed bumps. But one of the things that a company like this, a characteristic of a company like this is it doesn't give you a lot of dippy buying opportunities over its lifetime, and it's worth thinking about. All right, so I don't see any reason to rush off and sell any of these, at least not yet. Maybe if they get a little bit lower on the pars. By the way, Neogen's par was actually 2% a couple months ago.
Yeah, the only comment I would have on that, Mark, is by traditional core holding, are these overvalued stocks? I don't think any of those
Exactly
would be sell candidates. On the other hand, and this is a tracking portfolio, and given everything, we're not running it as a managed model portfolio, but I would just, right now, we're about right now, the 10.3%, I think, par for the portfolio is running about 3 percentage points over my par. If this were an, in fact, managed portfolio, I would disagree with your statement that we don't need to be selling something.
Yeah, absolutely.
I mean, that 2-point difference, we're setting ourselves up for 3 years or so down the road having some potential issues.
Mm-hmm.
Now, again, the problem is we could sell each of these and it wouldn't necessarily make a huge impact on the portfolio because it all goes back to what I said earlier. Illumina is the only one, even in those top 50 or the top 20, 50% holdings.
Mm-hmm.
And that's the flip side of the coin, that if this were 5 stocks out of a 15 stock portfolio, we might be unloading some of these.
Exactly.
These are 5 stocks out of a 130, 140 stock portfolio.
It's not quite that many, but yeah, it's something like that.
It's a large portfolio, and they represent a much smaller piece of what's going on. So I agree. Let's sit on them for the moment. I agree.
Yeah, I would. If it gets down to money market rates, I'd be all for it. But
or if money market rates get up to,
yeah, that could be the flip side.
Either one, right?
Yep. One of the other criteria that we use is anytime one of our selections lags the market by more than 20%, and there aren't any candidates right now. We've cleaned all of those out, so we'll be continuing to monitor that. But we've demonstrated that many times over the last 6 months, and we don't have any that fit that definition today. And the other thing we began watching is any of the stocks that hover in the out of the excellent zone down into the good, and we're not paying attention to the number itself, but more the trend or the direction. And I actually clicked through a bunch of these just to see, do we see any decline in the quality graphic over time? One example might be Price Smart. You can see that quality EKG up at the top has actually drifted downward, and with the next update, it'll actually go down and actually break that gray line. So we're actually going to be down at the end of this month, down in this range. So if our work in this area, as Ken has observed, in many cases gives us multiple months to make a decision on something like this, I would think if Price Mart persists and stays down in that dented quality condition, that could be reason alone to sell it. Any thoughts on
that? That last green bar on the graph right now comes from the end of August, right, Mark?
Yes. This would be August on the far right-hand side. So we're a couple of days away from the next point on the graph.
Mark, we have a hand in the air from Ann Manning, our friend in Texas, so I'm going to unmute Ann, okay?
Hi, Ann.
Ann, go ahead.
Hi. I was just wondering, when we're talking about the ones at the lower end and whether or not to get rid of them, if it would be beneficial to those who are new to Manifest, that if sometimes when we're doing this, if you were to do a worksheet and say, okay, if we got rid of these 5 lower companies, this was what it would do to our portfolio. Would it make any difference?
It's a good thought.
Just a thought.
Yeah, it would make a small difference, not a huge difference, but yeah, it'd be a good thing to demonstrate. I'll make a note of that, Ann.
It's not a good thought, and it's a great thought. It's a wonderful thing to demo and to show how a worksheet can be used in reality, in real time, to see what the numbers are going to do as you make some different changes.
Yeah, just a thought. So
we might actually tackle that at the end of the session here.
Okay.
Thanks, Ann. All right, and a couple last things just to make people aware. I think most people in the investing world are aware that S&P and MCSI actually made some changes to the classification system, created a new sector known as communications services. We actually just refer to it as communications at Manifest, but some of the companies moving around, you might find a little bit unusual. You've got the family of Google there, Facebook, but they also moved Netflix, Disney, and 11 other companies out of consumer discretionary into this communications sector. So they've done away with the telecommunications sector. It is now known as the communications services sector, and some of that is disrupting things a little bit. You'll see companies moving around. I haven't looked to see if they've actually formed a sector fund for communications yet for our sector scoreboard, but just so you're aware that is happening, and we've actually aligned with the GICS industry classifications too. So you see a little bit of a shift around at Manifest too. Here's the picture of what actually happened. Telecommunications was almost a non-contributor to this chart, and with the companies that they've moved around, they've trimmed the technology sector and trimmed a little bit of discretionary, and you can see that this communication sector is now pretty good size. Any thoughts on that, Si or Ken?
Well, I do know, Mark, that Morningstar is, if it hasn't already followed suit, it's going to be following suit and coming up close to the same type of definition for a new sector as S&P has right now. CFRA is the new designation for S&P. If you're looking for that in your broker statement, you can find it under CFRA reports. But I think what that's going to do is we've traditionally indicated that there are 5 sectors where you can exhibit a reasonable amount of growth, sometimes 6. And I think this is going to mean now that there are 5 sectors where you can find some growth, sometimes 6, sometimes 7. I still think energy, utilities, real estate, and materials are going to be at the bottom of the list as far as finding good, solid growth companies are concerned. But I think you will be able to find growth now in communication services, maybe not as regularly as you might in information tech or in healthcare, but at the same time, it's definitely moved out of the non-growth category.
Yep. The only other comment that I'll make, and you saw it some in the shift in communication services, but I wonder how much longer we really should have that information technology sector. I wonder if this may be the beginning of a trend, not necessarily creating new sectors, but shifting some of the information technology, as now technology, rather than, 20 years ago, certainly 30 years ago, technology was something new and something different and was something unique. Now it's simply a tool. Everybody does it. For example, tonight's pick, SLP, that Mark and I are doing, are classified in the information technology. You could make just as good an argument that it belongs in healthcare, because the primary client base and the primary area in which the information is used is healthcare.
Yeah, it's an agent argument.
I couldn't agree with you more, Si, that I think there's a lot of IT companies that really underneath their skin belong in a different sector based on the communities they serve and what they deal with and what they do. I'm asking myself if there isn't a place in this whole scheme for research. Right now, research companies like Simulations Plus and like a lot of the other companies that do pure research or contribute to academic or company type research, they're all over the board, all over the place as far as these sectors are concerned. And yet I really think that they have much more in common with each other than they might have with the sector they happen to be placed in.
Sure, that's a good point.
Yeah, and I can't leave this subject area without, again, reinforcing and suggesting to not be obsessive, certainly not compulsive obsessive about sectors. As the story we've shared many times, Tom O'Hara says he never made an investment decision based on sector. And, I can remember we wrote about David Gardner of the Motley Fool and his concentration in technology, where he went on to point out that, what sector does Amazon belong in? This was 5 years ago. He says, is it really a technology company or is it a retail company that uses technology? So, right. You can apply that to a lot of different companies, as Si and Ken have just suggested. So, again, don't obsess too much over sectors.
Well, especially don't obsess to the point where you feel you have to have a stock from every one of the sectors in order to be well diversified. I've heard that in clubs that I visited, and I kind of shudder. To me, if you have stocks from 4 or 5 of the sectors, no matter how they're defined, you're probably dealing with fairly decent diversity.
Yep. Nobody here in the audience tonight would do that, Ken. So
I know they wouldn't.
All right. Just a quick reminder, I'll do our 30-second public service announcement. Ken and I are churning with the help of many of you, including Marie Frank, who sent us the 100 fastest growing companies from Fortune. That's an article that came out here within the last few days. Between now and Halloween, we'll be continuing to build that best small companies list. Again, we're open to ideas. Send us an email. Send us a post on the forum. If you find a good looking, small, rapidly growing company, let us know about it. Here's how we've done over the last several years. As you guys all know, Ken and I lamented when Forbes discontinued doing this 3 years ago, and we kind of took over. And I think, knock on wood, but wow, these last 3 years have been pretty good. And this year, as we have just 1 month left before Halloween this year, the stocks that we picked on our best small company list are up 49% versus a market up somewhere closer to 10%. So we're actually going to scale change bash this chart if we continue to, and somebody knock on wood, because I'm probably dooming us to.
Yeah. Why are you talking about it, Mark?
Yeah, it's kind of like talking about a no-hitter in the ninth inning. But Neogen probably put a dent in us just tonight. But yeah, if we can bring this home, we're actually going to scale change this chart. So again, just play along, watch for the opportunities, and I know I will be personally investing in a few of the discoveries and hope for a continuation of this theme. So with that, we're about halfway into the program, and we can switch to our first stock presentation by Ken. This is LCII Industries. And Ken, you can take it away.
Well, this is the former Drew Industries, DREW Industries, if you happen to know the name of that company. It's been around for quite a while. And I've done presentations for Stock Up on LCII, and I think I've chosen this company once already for this particular portfolio, and so I'm choosing it again. Here's how I went about my whole process of deciding on LCII. I usually start by taking the worksheet, the dashboard that's on the front page of the Manifest Investing site. Over on the right-hand column, it says dashboards that you can share, and the roundtable dashboard is listed there. So I open it up, I sort it by par value, and I like to shop right around the place where the green numbers on par change to yellow background numbers on par. That puts it at the very top of the sweet spot, and I don't get wild and crazy. I like to go maybe 1% above the sweet spot, and I like to dip down maybe 1% below the top of the sweet spot. These are the kind of companies that I'm looking for on a regular basis, and I find I have a lot of success if I stay in that general area when I'm doing shopping. Well, there were 5 companies that met that plus or minus 1% from the top of the sweet spot, and they're listed right there. I was able to immediately discard the top one. I'm just not buying any Chinese companies anymore. I've just been burned enough, so I'm going to stay away from Chinese companies for a while. EPAM was a reasonable choice. I think Si's chosen EPAM a number of times. I hold EPAM in some personal portfolios, but it was already 1% of the portfolio. So that kind of left me with LCI, Skechers, and McKesson. I looked at my own SSGs for those 3 companies. I was extremely familiar with LCII, and I'm not so familiar with the other 2. I did a little surfing at all 3 websites and came up with a thesis for why I think it should become a generally good investment, and so I stuck with LCII. Next slide, Mark. I then went to the Chronicle for LCII. That's the quality graph that's at the bottom of every single page on Manifest. This doesn't have as much history as some of them do. I think probably this one dates from the name change back in 2017 or maybe the end of 2016. But I'm generally looking for a quality line that's either boringly horizontal up somewhere in the 90 or above area, or that has this nice solid movement in an upward direction. And you can certainly see that almost every move that's been made has been moving the quality higher and higher for this particular company. So it met my quality check without too many problems. For those of you that are new to Manifest, that red line is just par. And when I'm liking to buy a company with a quality that's moving up or boringly straight at a very high number, I also like to buy it when the par is kind of at a high place in the last 2 or 3 or 4 years. And you can certainly see that red line is at a high place from where it's been historically. Actually, in September, that par is up a little tiny bit more than where the August line was. So all in all, everything in the Chronicle fell into place, and so I continued my study. I then went to Value Line, And lo and behold, LCII was one of George Nicholson's triple plays. Let me go through the triple play really quickly again for those of you that have never heard of a triple play. Nicholson said, look for three things, and if these three things occur, then you might have a great candidate for study of a stock. And the three things are a depressed stock price. So up in the upper left-hand corner, I've circled the projected returns according to the value line analyst for the next 3 to 5 years. At the low side, they're predicting about 19%. At the high side, about 31%. Well, returns like that are spectacular at the low side, let alone the high side, indicate to me that the stock price might be a little bit depressed. So that was leg one of the triple play. Leg two is the possibility to have PE expansion going on. You know, a stock price just doesn't have to go up to make things work really well, but sometimes the actual PE can expand and push that stock price even higher. And I'm looking at a PE ratio at the time of this value line of about 12, and I'm comparing it to their 3 to 5 year call of a PE of 18. You can see I've connected the two circles with an arrow right there, and that's certainly expansion from 12 to 18. So that was leg two of the triple play. Leg three of the triple play is the possibility that net profit margins are going to be able to expand as well. I looked at the 2017 net profit margin number at 6.8%. I looked at the 2018 estimate at 6.9%, and then I went over and looked at the 3 to 5 year call, which is at 8%. Now, for a relatively low profit margin industry, going up a full percentage point from around 7 to 8 is significant. And so there's the third leg of the triple play. Now remember, Mr. Nicholson never said these were automatic buys. He just suggested that these were great companies to study, and in his experience, many of these became outstanding opportunities if the rest of the business model seemed to be in place. So that's everything going for it so far. So then I went to their website. And the first thing I reminded myself about the company is they operate in 5 different businesses. OEM is original equipment manufacturer, towable RVs, and you can see that that's a pretty good chunk of their total business at $1.5+ billion out of a $2.4+ billion company. The second category is original equipment manufacturers, motor homes themselves that you don't tow, that move around with their own engine and you drive them. The third was original equipment manufacturer, adjacent industries, and we'll talk more about that, but that's basically buses and boats and all different types of vehicles where some of the same things that you would put into a motorhome or a towable motorhome could go into those particular kinds of vehicles as well. There's the aftermarket that they operate in, and the aftermarket is basically selling parts for used recreational vehicles. And then there's the international market, and you'll notice that some of these categories are growing at phenomenal rates. The yellow numbers in the far right in the last column there are showing you the growth rates for those various industries, various components within the total company. And you'll see that international, for example, is growing at 76% year over year and has been growing at pretty phenomenal rates for the last 6 or 7 years. That's a pretty decent growth rate for the whole company, that 31% at the bottom of that far right column right there. So their biggest business is their slowest growing, but other parts of their business are also beginning to grow much more quickly. When this company was Drew Industries, OEM towable components represented much more than half of the business. It still represents more than half, but it's moving down so that the other parts of the business are starting to lend themselves to the profit making that exists. Next slide, please. This is the kind of stuff that LCI makes, all kinds of things that would go into either a towable motor home or a motor home with an engine in it. And some of these things go into adjacent industries. Just look at windows, for example. They supply window components not only for motor homes and for things like that, but they supply boat windows and school bus windows and various other types of window units that you can drop into various other kinds of vehicles. So you look at the vast array of different things, and you'll note that some of these things depend on aluminum, which is going to be having some, which is dealing with tariff issues right now. But there are things that you wouldn't even think of when you're thinking of parts, looking at awnings and mattresses and levelers and things like that. So LCII makes a lot of different things for the vehicles that make up their industry. Next slide, please. You wouldn't want to believe this, but millennials are fueling the growth. And there's the data for it right there. Millennials are 31% of the population, but they're 37% of all campers. And they're buying campers at a faster and faster rate. It's the largest generation that exists right now, and that largest generation is aging into the sweet spot for recreational vehicles. So millennials are not necessarily the largest buyers right now, but they are definitely fueling the growth in the industry. Next slide, please. And I'll drive that home by showing most of you that if you're a typical better investing audience, then you're on the white line up on top. That's the baby boomer generation, the white line and the light blue line. And you'll see that the white line and the light blue line are either fairly stable or actually in decline, whereas the millennial lines, the red and yellow lines, seem to be moving upward. Next slide, please. And this is the key slide that shows how the millennials are going to change the business and change the sales prospects going forward for RVs and associated vehicles, because as we move into the 2020s, that portion of the population that is currently the millennial generation will be in the ages of 35 to 44, and you can see by 2030 there's expected to be a key rise in that particular cohort of the population, and that's going to fuel growth going forward. So the long-term trends for this industry are in place. Next slide. Where is the company going next? Well, they are moving aggressively into international RV. They're doing a lot of small acquisitions. They're being very careful to acquire companies that fit with the other companies they already own and that contribute to the same types of things that they're already doing. A huge push into the aftermarket. Almost half of all RVs that are considered new to people are actually used RVs that people have purchased, and those used RVs need a lot of parts. The highest margins by far are in aftermarket parts. They're not in original equipment manufacturing parts. They're in aftermarket parts. And then they're also looking to open up additional markets with these adjacent types of vehicles. Next slide, please. Here's just some facts about the international markets and some of the acquisitions they've made. Europe has now moved up to second place behind the United States in unit production of RVs. That's with all RV companies. So it's very quickly growing. It's a trend in the European markets that is growing, and LCII plans to be part of that trend. Next slide, please. A lot of R&D going into this company. They own a lot of patents. They just received a patent on levelers for the RV, for the towable RVs that are self-leveling. So you get yourself to a campground and you can't find a place where there are 4 places that you can level your thing to the same notch on the old-fashioned leveler. Well, these are electronically working, so they will level themselves for the RV. Really nice a movement forward, and it's selling extremely well. Next slide, please. This is one of their biggest opportunities in the aftermarket. These are the highest margined products, and that's certainly a way to up pre-tax profit if you're selling higher margin products than you were before as a greater percentage of your total sales. Next slide, please. Here's an example of some of these specialty vehicles they call adjacent markets. A lot of their business with school buses, heavy trucks, and trains. A lot of things like stairs and window units and different types of sleeping quarters on large trucks, creating kind of RV-like pods within the large truck for the cross-country hauls and everything. So they haven't sat still in moving into other areas. Next slide, please. Here's their graph, and the first thing I wanted to know was, are there going to be large tax issues that distort the visual analysis? I added the net income line to the SSG plus, that's the orange line. The distance between the pink line and the orange line represents taxes, and you'll notice that that distance has remained relatively constant since 2010, which means the tax bill has stayed relatively constant since then, which means there was no need for them to pay an unanticipated type of tax or to get a tax windfall from the new tax law. Now, they will get a windfall by paying less tax going forward, but they're not paying any sizable repatriation tax, and they didn't have any deferred taxes that they either got a bonus on or had to pay extra money to balance out. The recent quarter, I think, was nothing short of spectacular. And I think sales at 25%, earnings at 17%. I think this is an example when the price bar went down. Note where the price is beneath the 52-week high right now. Look at that red tick. I put a big arrow pointing to it so you can see it. I think this is an example of the analysts hearing what they wanted to hear and not listening to the entire story. LCII does not sell to a single supplier of RVs. They're not dependent on a single brand. They're a worldwide company selling to the world. They provide equipment for almost all brands, and because one of the brands might be having some issues, or because towables or self-contained RVs might be selling at a slightly slower rate, does not necessarily mean that LCII is going to slow down. I think this is a wonderful opportunity right now to pick up a high-class company at a very reasonable price. Next slide. I used PEs that were extremely conservative of 21.5 and 13. They do pay a sizable dividend. I used a payout ratio of 38%. I use sales growth rates of sales at 13, earnings at 15. You can see there's little debt. The return on equity is very nice, and the profit margins are kind of moving around a little bit, but the last 3 years, the last 2 years, they've stayed above the 5-year average. I'm getting a buy. with a par value of about 18.6%. Next slide, please. And then I look finally at the manifest par value. Mark's value coming from the analyst is 17.8%. I compare that to my SSG value of 18.6. For my money, that's the same number. It's a really high quality company, and I concluded that I'd like to put another holding of LCII in this tracking portfolio. That's it, Mark.
Okay. Well, thanks, Ken. Yeah, that's quite a story, and many of their operations operate out of Elkhart, Indiana, and we actually talked at the National Convention how Elkhart, Indiana is having trouble even getting enough people to man the factories. They're actually having hiring bonuses, so their business is definitely booming, and it's probably got a lot to do with that gently sloping graph that you had up there just a few minutes ago. All right, so with that, we will switch gears and go with our two-part presentation on Simulations Plus between Cy and myself. And Cy, why don't you go ahead and kick us off?
All right, I'll take over. Thank you, Ken, for a very good company. Now we'll move on to an excellent company, Simulations Plus.
You're not lobbying for votes already, are you, Cy?
Would I do that? I remember I've got the handicap that Mark came up with this stock too. So,
all right.
Fair enough.
But I'll try and leverage the 2-for-1 advantage too. But Simulations Plus is what we're going with today, and here you see relatively strong up straight and parallel, a little bit of dips early in the decade, 2012, 13, but generally headed in the right direction. Remember, though, as we get into some of the numbers, and I'm just glancing at this, yes, this looks like these are actual numbers, not scaled. It is quite a small company, only around or less than $50 million in annual sales right now. Next slide. This is just the front side of my stock selection guide, showing you the same basic information that Mark had on there. And you can again see currently it's running in the 30 million or so range annually, because these aren't actually scaled to actual numbers, but you can see the numbers. Next slide. Interestingly, I followed the same basic approach that Ken outlined earlier in coming up with Simulations Plus. I went to check the portfolio. I was looking again right around the sweet spot, top of the sweet spot line, maybe just barely into the yellow, around the top of the green. As you know, I have looked at EPAM and have brought EPAM a number of times, so I saw it. I'm familiar with it. I thought that it certainly had some potential promise, so I said, let's take a look at EPAM. Next slide. One of the tools that Manifest gives you when you are doing a stock study, you can do a very quick industry and even sector comparison. I of course frequently like to actually do a full industry comparison, but here I just used the two boxes at the right hand column. Just looked at, you see EPAM is at the top of potential return for both the technology services sector as well, or technology services industry as well as the technology sector. Emphasis, which is also in the portfolio and relatively familiar. You see Cognizant, and then IT and IBM in the technology services. Then further down, I did look very briefly at MCHP. IPGP is a company that's had a bit of a dip in price, has some current challenges. The question is temporary or or more permanent. That certainly was a company I would have considered, but I was kind of interested in a new company today, and so SLP is one that I was not particularly familiar with, although I've seen it on a few screens. So I said, let's take a look at it. So next slide. And here is just an abbreviated version of the default Eagle at Manifest. You see the quality at 95, the par at 14.6, strong sales growth of 16%. So all of those were looking very positive. And like Ken, I do also like to look at the Chronicle. You can see the green bars are showing fairly decent price growth recently, but despite the good price growth, note that actually par is at a relatively high standard historically, as well as the solid pink area, which is the relative par, that being the par relative to the MyPar. So again, Simulations Plus looked like a company that would be interested, that I'd be interested in studying. So next slide. Here is just a quick outline in the next two slides from the company's website and also from Morningstar, what the company does. They say that their mission is to improve productivity in science, research and development. As we'll see, it's primarily pharmaceutical and medical research companies, but it's somewhat broader than that as well. And they do modeling and simulation software, and then along with their software, they do some consulting. Next slide. Three of the products, main product areas that Morningstar mentions fall within the pharmaceutical research area, going by the acronym ADMET, for absorption, distribution, metabolism, excretion, and toxicity. Those are all important things that are looked at when you are looking at pharmaceutical products. And Predictor takes the molecular structures and looks at them and allows the researchers to vary the molecular structure and see what impact it has on the ADMET factors. Then the Designer goes in and allows, again, the chemist to change the predictor properties and go back into the molecular. So Predictor and ModChem, as I understand it, would be looking at the same factors, but from two different directions. What impact on the factors does a change in metabolism structure have? And then the flip side, you change the ADMET factors, to get that change, what molecular structure change is necessary. And then the MedChem Studio allows them to track data and again design new drug molecules. Next slide. This is my judgments for Simulations Plus. I went with roughly what Manifest had for sales, which is 16%. The net margin is actually below the analyst consensus Manifest numbers at 29.2. I think Manifest default is in the 30s. Well, I know it's in the 30s. I think it's actually the mid 30s, as I recall. I used roughly the same PE. I think my PE may be slightly higher, 35 instead of 34, but in the same basic place, and came out with a projected return of 13.8%. Certainly a strong growing company in an area that is certainly demographically as well as economically, I think, a growth area. The demographics, of course, as the population continues to age, we continue to increase our need for healthcare and for pharmaceuticals. As the economy starts contracting or growing slower, pharmaceutical companies and other health companies are going to be looking for ways to help reduce their costs, and certainly being able to do computer software simulations as opposed to traditional chemistry and trial studies will be a way to be more efficient in their research and development. So I say let's move to an excellent company in our portfolio, Simulations Plus. What say you, Mark?
I like the idea. I think it's an excellent company, and it's the type of company I want to talk about for just a few minutes. It's something that, Ken was talking about how we used to encourage the overall portfolio to have 10% growth, and then we kind of shuffled it up to 11 based on the works of Mr. Nicholson. And no, I'm not so sure that we shouldn't be pushing even a little bit harder, maybe as much as 12 on the average objective. And part of it comes down to this statement by Buffett made several years ago that you can't grow Berkshire Hathaway like this anymore, but he thinks that he could, with a relatively small portfolio, achieve magnificent growth rates. And then I just look at what we've done over the last 3 years with the best small companies, and I think we want to be looking for more of those type of companies all year long for the roundtable portfolio. It's also a nudge to remember the work of a guy by the name of Chuck Almond. Chuck Almond used to write the Growth Stock Outlook newsletter, one of the top-ranked newsletters by Hulbert Financial Digest, and he also contributed a column to Better Investing magazine. And you can actually go in with your Better Investing subscription, and I don't know how to get to the stuff. This is what it used to look like on the old website. I think the new is shuffled around a bit, but you can probably still access these articles by Chuck Almond. There's some real nuggets there. One of the things that we got into a few years ago was the fact that he had such enormously high returns despite being a perennial bear. In fact, we referred to him as the dancing bear, hence the bear on the slide. And one day Ken Janke asked me to run some calculations to figure out how in the world he could achieve these top returns at the Hulbert Financial Digest when he had 40, 50, sometimes 60% in cash equivalents. And one of the ways he did it was companies like Mocon. And Mocon, again, was a relatively small company, probably in his backyard, that just delivered excellent results year in and year out. And it was also one of these companies in that kind of that same size range as Simulations Plus, as I just presented it. Again, relatively small company, but excellently managed. So you can actually go to that link. It's a public link, and there's an article there about how to pick a good growth stock. So one of the things I did is I went to the database, and again, coming at this from a slightly different direction than the other guys, I wanted to find companies with growth rates in that 15 to 20 range that still had top tier projected annual return forecast, and quality. And the numbers on the far left are the position in this year's best small company list. You see the 7, 18, and 19. Some of those are companies that you guys are very familiar with. But again, looking down this list, some pretty good companies, pretty good expectations, pretty good quality for some relatively small companies. But some of these have been kind of on fire. The analysts certainly don't have the higher expectations. I kind of ran out of red ink. I was shading the stuff that I didn't like, looking for, doing some real panning or screening here. And I ended up with Superior Group at the bottom. That's a worthy study, by the way. That was on my short list. Silicom, which I don't know much about, but again, it didn't have any of the more negative aspects. And then up at the top, if we look beyond the analyst consensus and look at the real situation at Simulations Plus, it just makes the chart, and decided to go with it. I was down to those three, and it kind of matched up with what we were after. Again, here's a look at what Cy has just described for you. Again, these guys are in research in a very key area of human life, and I'm just compelled by the rate of growth and the size of the company and the excellence of management that we see here. We see basically up, straight, and parallel, that small flat spot in the early part of this decade. But we're looking at a company that is very profitable, that has a really nice looking profit characteristic there, and PE ratios, which as the company has been a little more discovered, have actually risen and increased into the high 20s to low 30s. And certainly for an exciting small company, that's not an out of the ordinary PE. You can see with a growth rate of 16%, 30% margins, and a PE around the 30 range, we are talking about low teens for the return forecast. And again, that is nice and compelling. And this is the type of company that can really be quite rewarding over the long term. Here's what it has looked like. Again, I go back to how long ago did you run into your former student in the mall, Ken? Are you willing to disclose that?
Well, I just got a note, Mark, from somebody in our audience. I told that story about running into my former student, and I told it at convention, and that was in the 2015 convention. So so I probably ran into her sometime in February, March, April of 2015.
Yeah, so the nutshell version is she's actually a biochemist, as I recall, and actually works.
She's a researcher for the University of Michigan, Yeah,
so she works with molecular chemistry, and I know that Ken probably assumed ownership of SLP somewhere in that time frame. So you can see it hasn't been a straight line from here to there, but he's had a pretty good run over the last 3 or 4 years. And as you go back all the way to the 2008, 2009 timeframe, you can see it's come out of that recession and, again, performing very well, even with the downdraft. And by the way, it's come down about 25% in the last couple of months. We're still looking at a year-over-year return of 34%, even after the price relaxation. So,
Mark,
go ahead.
I went back and checked, and I actually bought it after I talked to my former student, Aaliyah. We bought it in the middle of March 2015. We sold it out of a taxable portfolio just after the new year in 2016, and then bought it back in the middle of 2016 in a non-taxable portfolio. And since that point, we've made about 163% up to yesterday.
Nice.
On that stock. So it's the kind of stock that if you're careful with it and if you give it enough leash to run, and I've been telling Mark since we started traveling with each other that you have to expect the same from your small stocks as you expect from your large holdings, and that means you want history and you want up, straight, and parallel.
Yeah, and we certainly see it here. And again, it's a reminder that, again, this is a key strategic area. And just asking a former STAR student the question, what exciting thing is happening in your vocation? And she described this software. And here's basically what it is. Si's already covered it, but what it really boils down to is these guys are optimizers. They basically take the task of these drug development and chemical companies always want to be making product, and they have to go through this test process. And they want to minimize cost, and they want to keep the pipeline stocked, and they don't want these dead ends. And what they're able to do with this modeling, picture, if you will, a cafeteria-sized room full of Petri dishes where they're testing, a potential new solution for some ailment or disease. And you basically have these Petri dishes, as far as you can see. What these guys basically do is they make it so you can boil that down to the more likely success stories and probably operate with one single table full of Petri dishes. So again, they're streamlining and optimizing the solution seeking process, and basically putting companies in a position to deliver successful products in a much more cost-effective way. That's what they do. And you can go to simulationsplus.com/about, and there's a nice video about 5 or 6 minutes long, which describes how they do that sort of thing. And so I'm going to go ahead and add it as the second stock tonight, again, with my emphasis on higher growth rates and smaller companies, to be searching for those type of companies and make sure we have enough of those in the roundtable tracking portfolio over time. And they can be wonderful opportunities for growth. So with that,
Well,
Ken,
Mark,
I think we can go ahead.
I'm gonna put the poll out there and give our folks time to choose either LCI Industries, Simulations Plus, or none of the above.
And I don't know, Si, do you own any LCI Industries? Because I know Ken and I both do.
No, I do not. Back in its Drew days, it caught my eye a few times, but I have not bought it.
So in the spirit of full disclosure, I wouldn't be voting for LCI right now. I'd be voting for the one I picked. But I did present LCI last month, by the way, and do own some shares of it. We own. Wendy and I own some shares.
While I'm waiting for the voting to close now, I'll tell you that there's a number of competitors for LCI that make a really interesting industry study. One of them is called Patrick, P-A-T-R-I-C-K Industries, that you might look at if you're going to study this company. I have 90% plus voting, so I'm going to close the poll. And takes two of you to gang up on me here, but you know, we're going to add an extra simulations plus. I don't know. We're going to put 4 in there or 3 in there, Mark?
I think we'll probably just go with 3, but I don't know. What do you think? Okay. What do you think?
Well, I don't know. You both chose it. I'd put 4 in there. So, but I'll leave that detail up to you. But obviously, you can see that 68% of the folks think that this is a really interesting company. Mark, if you get a chance to go to the coming events while I start to organize the questions here, we'll be all set then.
Okay, and again, coming attractions, we do have a portfolio review session coming up. Ken and I will both be in Troy, Michigan on October 6th, working with the Michigan chapters here. The next Turnout Tuesday will be on October 16th. The subject of that will be the best small companies, an update, and at that point in time, we should be more or less finalizing the list. A couple weeks later, after the portfolio review session, I'll be in Washington, D.C. for a joint session of the American Association of Investors and Better Investing, talking about wisdom of the founders, comparing some of the work of James Clunan and George Nicholson, and really excited about that one. Our next roundtable will be October 23rd, about a week before Halloween. Ken is going to saunter down to Charlotte, North Carolina for a program on the 27th with the volunteers and the investors in Carolina. Hopefully the hurricane will be done down there by then. Early November 10th. This one's for Herb Lemkool. He's pointed out the last 2 times we've held this session, we do have our annual Stock Pickers Breakfast. Is that in Bay City or Saginaw this year, Ken?
It's in Saginaw at the Horizon Center in Saginaw.
Saginaw Horizon Center. So if you're within driving distance of Saginaw, that's a fun morning where we just share some ideas and enjoy a good breakfast. Ken and I will be in Chicago sometime in the spring of 2019, Pittsburgh in May, and the NEIC National Convention is in Chicago next year, mid-May, May 16th through the 19th.
So I'm going to start by going to people that have their hands raised, and we have Kate Smith with her hand raised. So Kate, go ahead. You're unmuted.
Yes, Ken, I was just wanting to know how the LCII is working towards the integration of electric motors, electric cars. That seems to be a future that is happening faster than most of us anticipated.
Yeah, remember that LCII doesn't make the vehicles. They make the components that go into the vehicles, and they're not awfully engaged in the engine components, Kate. They are engaged in almost everything else in the vehicle, but they leave the engine and the drivetrain to other industries to handle. So I don't think that they have any direct involvement with the electrification of the fleets. But rather they're just providing all types of other parts. Again, they stay away from the engine and the drivetrain.
Ken, if you're handpicking questions, I think we'll go ahead and leave the recording on for another couple minutes, and then we can go Light
Okay.
after that.
We have a lot of questions, so let me just kind of go through some of these at random and see what we're going to go. Cindy wants to know, how can the roundtable be viewed after the webinar? Cindy, there's a YouTube channel called Manifest Investing Roundtable. It also is entitled Mid-Michigan Roundtable. We'll take you to the same place, and on that YouTube channel, you'll see all the past sessions of the roundtable, and you'll also see past sessions of Turnout Tuesday. Mark is kind of showing you on his screen right now what that looks like, but you can go to YouTube and just search. Mark is searching for Manifest Investing, and there it came up, Roundtable, and then he's clicking on it, and at that point, he joined that channel. And once you join a YouTube channel, you'll get some notifications when something new gets posted, okay? Joel says, we picked IPGP last month. Since then, the stock took a hit. What's going on with IPGP? Mark, you want to take that one, or Cy?
I'm not familiar exactly with what has happened.
Okay, well, I noticed the timing of the question. I'm not sure which hit you're talking about. There was a significant hit to IPGP in late July, early August, when they reported their quarterly earnings. And again, they reported, it's one of those good news, bad news, or perspective issues. They reported record results, but their guidance going forward was a significant slowdown in the business, to a great extent with concern over China and tariffs. And so that was the cause of the drop. Then there was a second drop of nowhere near as large, maybe a 10%. No, it wasn't even 10. It was probably about 3 or 4% at the beginning of September. That I'm not aware that that's anything other than just a normal market bump, as they're trying to figure out exactly what's going on. But the biggest thing to realize about IPGP is if you put up a price chart for the last couple of years, it was on fire. I think the stock got way ahead of itself, and the market was looking for an excuse to sell, and it got a good one with the August earnings report.
And I'm going to just shout bingo, Cy. I think you hit it right on the head. I think this is a clear example of a stock that just got way, way ahead of itself price-wise. The PE shot up, and I think it's still an amazing company, and I still think that it's given people really great returns if they've held it for any amount of time. But I think you hit it right smack on the head. Don wants to know, can you find the best small companies lists on Manifest? You sure can. If you go to the home page of Manifest Investing, and then over on the right-hand column, you'll see published dashboards. And down at the bottom of that list, you'll see more. If you hit more, then you'll find all the Forbes lists from longer than 3 years ago. Plus, you'll find our own list that Mark and I have been putting together for the last 3 years, and that's where you'll find the newest list once it gets completed as well. So there's all kinds of public dashboards listed on Manifest that are free for you to take a look at if you're a subscriber, okay?
Yeah, and it's also in every weekly update underneath the as part of the update, we have the best small companies list, and then there's also features every week.
I'm blushing because Michael Campbell is telling me that on the same time I recommended Simulations Plus, I recommended FBMS and WD, and one of them's up over 100% in the last 3 years, and the other one's up 88% in the last 3 years. So thank you for that acknowledgement. I'm not sure that I'm that good, Michael.
Well,
It's better to be lucky than good, I think.
well, first of
So,
all, Walker Dunlop was mine.
well, he says he keeps a very accurate list, Mark.
Oh,
So.
okay, okay. Well, we'll take his word for it.
Terry wants to know if I think that LCII is a cyclical company. Well, of course, Terry, many consumer product companies are very cyclical, and they do depend on the economy and when the next recession comes. And keep in mind, we will have a recession again sometime in the future. I would expect that this business will suffer right along with many, many, many other consumer companies. People will not be looking to run out and buy a recreational vehicle if times are really tough. So you have to keep that in mind. A lot of highly cyclical companies are looking like growth companies right now, because for the last 5 or 6 years, we've been in a pretty decent bull market with things just going in one direction, and that's up. So don't be fooled. There will come a time when some of these companies will reveal their true colors and go back to being cyclical again. But I don't have any doubts that this is a cyclical company and will continue to be a cyclical company.
Yeah, and I've got the value line page up, Ken, and you can actually see during the last, and keep in mind this was a vicious recession, the stock price actually went from 44 to 9 during that recession. So it is something to keep in mind. And if we started to see vulnerability to recessionary conditions, in the portfolio, and it made sense within a portfolio, that could be a factor of consideration. Cy, you were going to say something?
I was going to say, actually, it went to 5. It must have been in early 2009.
Yeah.
So it went even below the 9.
And this one took longer than a lot of the stocks that we typically follow to recover. If you just follow the line across, the line at 40 across the graph, you'll see that it didn't truly recover until sometime in 2013. So, there's a lot of stocks out there that do go through cycles, and I would hope that we would not see a cycle as vicious as the last one. But that being said, this is a cyclical company, as are many of the companies that we look at on a regular basis, okay? Ken Mobley from Central Pennsylvania is just telling us hello from Peru. He's down in Peru sourcing organic produce for U.S. retailers, and he's happy to join us from Peru. So that's the first time we've had a South American voice in the audience, I think, Mark,
Not, certainly from Peru. We've had a Brazilian before.
That you're absolutely right, I'm going through questions right here. Stewart says he's always been a little leery of luxury producers. What are the prospects for LCII when the current expansion starts to slow? I think LCII is making a really great attempt to move themselves away from dependence on just towable recreational vehicles. And given enough time, I think there'll be a fair amount of business in vehicles that aren't nearly as cyclical. I mean, you're still going to need school buses, although school budgets will be pressed hard to buy some of those buses. You're still going to be looking for fleets of delivery vehicles, for other types of vehicles. And then this aftermarket that they're really putting a lot of money into. Remember that if they're not selling new RVs, there are still tens of thousands of old RVs that are on the road. And I think that the aftermarket is a great opportunity for LCII to make some decent money at very high profit margins. Tom wants to know, what about steel prices and tariffs? Well, I think the tariff issue is legitimate with LCII, but it's not so much steel as it is aluminum. Most of the components that LCII produces have large components made of aluminum rather than steel. Sharon wants to know, Sharon's asking again about the small company lists, and we've already dealt with that. Anybody want to take a run at any of the stocks that were mentioned at the beginning of the session here?
Well,
Mark, either go on.
We can take a quick look at Northern Trust, just to come at it from, because there's been so many banks and so much activity in this area. Maybe we can just take a quick look. Again, Northern Trust has been on a heck of a run for many years. I'm not sure the nature of the question that was asked, other than, I mean, you're not going to set the world on fire with returns, but this is a pretty solid company, probably with pretty close to double-digit returns, 8 to 10%. We'll take a look at Manifest here in a second, but these guys are also in asset management. And taking a look at Northern Trust and how they stack up within their industry, good company. Again, as I mentioned, the return forecast of 8% or so. I think you can probably find some pretty favorable comparisons when you compare against some of the other banks and opportunities that are out there. There's a lot of them, but these guys are they're a formidable company. I don't know if they've suffered recently, and we'll take a quick look at earnings expectations for the next year or so. Looks like they're still going in the right direction. And you guys may have noticed I pulled this up for IPG, and they were going in the wrong direction here. You can see that these are still bolstering and actually looking pretty good. No downward draft, whereas IPGP had a pretty nasty looking picture right here with the EPS trend. What other company would you like to look at?
Well, I'll address Healthcare Services Group, HCSG. I happen to own that in a couple of clubs that I'm in, and I own it personally as well. Healthcare Services had two large clients renege and go into bankruptcy. This company provides dining services and cleaning services to the retirement community, to a lot of retirement homes, to a lot of assisted living places, a lot of Alzheimer's units, things like that. And they had two large multi-state clients go into bankruptcy and not pay their accounts receivable. So they had to write that off, and that shows a sudden drop then in earnings that you can see very clearly if you pull up a graph for the company of sales and earnings. That being said, the company moved very quickly to tighten the requirements for payment. Payment used to be on a monthly basis for most of the contracts. Healthcare Services has moved those contracts down to biweekly payments, or in some cases even weekly payments, to try to not have this problem occur again, or not have it occur in the place it was. Now, these two companies that went into bankruptcy are in reorganization right now, and everybody feels that the two companies will be paying something on the bills that they owe. So at some point in the future, probably within the next 6 months, according to one of the analysts, Healthcare Services should be recording a positive entry because they will get some payment from these two bankrupt companies. How much is still up in the air, but something is better than nothing, and right now they've written off the entire amount. That being said, they still operate with a 90% plus client retention on the contracts they write. They still pay a significant dividend, and the dividend appears to be very, very safe. And the company is not operating in an area that is discretionary. They're doing, like I said, food service, and they're doing cleaning services, two things that these types of facilities have to have. And once the healthcare services gets a contract, it tends to be very, very sticky, and it tends to maintain that contract for a long, long period of time. So all in all, I'm holding on. And in fact, one of my clubs has been buying extra positions in healthcare services now for the last, I'm going to guess, 6 or 7 months. We've been putting a little bit more money into that club, into that stock on a regular basis. We might be wrong, but then again, we might be right, and we feel right now that everything points to a bottom and points to better times ahead for the company.
Yeah, I was just noticing that the earnings expectations for end of this year and end of next are not that diabolically off of the long-term trend. So this could be a clear case of potential overreaction.
Well, I think what scared people, Mark, is you could actually see the decline with those the loss of those 2 large contracts. So it really spooked a lot of people, I think.
Sure.
We're going to have to hold on STLD and MKTX and Air Lease because, frankly, we talked a little bit about Air Lease, Karen, but Don and Marty, we don't have anybody here right now that has enough information on either of those 2 companies. Mark, can you make a note, Steel Dynamics and Market Access, and we'll try to find out a little bit about both of them before our next roundtable?
Yeah, I do show Steel Dynamics is an interesting story to dig into. Almost excellent quality and pretty good one. MKTX, I know, has been showing up on some screening results, I think. Very high quality. Looks like they've had a pretty good run up in price. And what was the third one? Oh, Air Lease?
Just those Air Lease, yeah.
And Air Lease, there are volumes of information on Air Lease in the Manifest Forum.
Yeah, you just need to go to the Manifest Investing Forum and do a search on Air Lease, or Mark is showing you the use of the spyglass up next to the name, and you get just all kinds of posts because this is a favorite of the Manifest community, and we have some folks that are really, really top-notch in analyzing this particular company. I'm looking clearly. I have a hand raised again, so let's see if we can talk. This is oops, I just lost it. Hold on. Marty, it's your hand, so I'm unmuting you. Go ahead.
Hi, guys. How are you all tonight?
Hey, Marty.
Just real fine. It's good to hear your voice.
Good, good. And same to you. I just, on the market, Taxis, it's a company that Dean Alden, one of our senior OKI investors, brought to my attention today. And yes, that has had quite a market price run up, and Value Line gives it a -1% low projection for 21 to 23. However, they do give it a 16% revenue and earnings growth over the next 5 years. So, and they're saying that they still have room to grow. So I think it's something folks can be just taking a look at. This fintech industry seems to be kind of growing out, expanding. So just a thought about it.
Okay, sounds like a good one to dig into. It certainly has quite a track record, and I will agree. I work with fintech guys. Yeah, it's an area of expanding opportunity for many things, and I think these guys have a very diverse client base.
I just cleared the notes, and we have, Michael is now telling me that you were the one that recommended WD.
I'll tell you, I'm not going to forget that one because I went to the Motley Fool annual meeting, and that's where I met Mr. Walker and spent some time talking with him and Tom Gardner, Walker Dunlop, and I brought that to the attention of the Better Investing audience. because we had our
Well, it
annual
was
meetings in the same place.
It was a wonderful pick in 2015 going forward,
Yep.
making almost 100% in less than the 5-year time period that we kind of set as a benchmark for our stocks.
Right,
So,
and again, it underscores that point of find a company that has a great culture and leaders who seem to know what they're doing, and a field of opportunity that makes sense. And again, finding a small company that fits that description can really be awesomely rewarding. So that's probably a good place to end our discussions tonight.
absolutely. I have the question box cleared. I don't have any hands in the air. Usually when I say that, one jumps at me, but nothing's jumping tonight. So, Cy, as usual, thank you so much for helping out tonight. Mark, couldn't do this without you, buddy. And I'd like to thank everybody for coming this evening. Hope you had a good time. Hope you learned something. And we'll be back with Turnout Tuesday coming up on October 16th. Okay?
All right.
Talk to you all later.
Good night, everybody.
Good night, everybody.
Good night, Cy. Good night, Mark.